All right.
What a perfect segue into James Bianco. Jim Bianco joins us from Bianco Research. I want to make this clear. I announced Lindsay Pieggs as my Economist of the Year, and I mentioned in it Jim Bianco led the way. He's the one who first said, maybe rates aren't going to come back to where John Williams wants them. And Jim Bianco joins us this morning. I assume, Jim Bianco, it's a choiceful Fed. They're making decisions thoughtfully. How data dependent is our choiceful Fed?
Well, hopefully they're very data dependent, because the data, I think, is telling them that they should not be cutting rates in December. And I'll even go you one step further. If they don't cut rates in December, there's a reasonable chance that the rate cutting campaign ended in November. That's because the economy's doing fine. Inflation has now had 43 months in a row where core CPI has been above 3%. I don't know where this soft landing talk is coming from, because we're not having anything like a soft landing. We're having a no landing. And now we've elected Donald Trump, and we're looking at massive fiscal stimulus. We don't need the Fed to be cutting interest rates in this environment. The stock market's at an all-time high. Bitcoin's pushing 100,000. Financial markets are not having a problem with the current level of interest rates. So the Fed adding to all of this by continuing to stimulate with cutting interest rates is just going to foster more inflation. And that's why I think if they were data dependent and they were looking at the strong data that we've been seeing, the sticky inflation that we've been seeing, the ebullient markets that we've been seeing, they'd back off on these rate cuts. And I hope that's what they do.
Isn't the bond market kind of already telling us that, Jim? Because we've seen rates rise pretty substantially here, despite the fact that we do have the Fed cutting rates.
Yeah, it is. We were at 3.6% the day before the Fed started cutting rates in September. We're at 4.4% right now, so that's an 0.8% rise. That's the biggest rise after the Fed started cutting rates in at least 40 years. But prior to that, it's kind of hard to figure out what was the date they started. But it's been many decades since we've seen interest rates go up like this. I think that's a message that the bond market's sending to the Fed, that these rate cuts are not needed. Now, Jay Powell was asked about that at his press conference, and he said, well, we don't know what the bond market's telling us why rates are going up. Maybe they go back down and it doesn't matter. And then Austin Goolsbee was asked the same question, the Chicago Fed president, and he said, the Fed has to figure it out, is what he said. So it's telling them what they want. They just don't want to hear it right now, because they seem to be in this mode that they want to cut rates.
If we get a Bianco nominal GDP, dare I say, Jim, a run rate above 5%, is that harmful to our listeners and viewers?
No, it shouldn't be. There's a perception in the world that rising interest rates are bad, falling interest rates are good. Rising interest rates not necessarily bad. If the economy is growing at a fast nominal rate like 5%, then that's where they should be, is at 5 or 6%. And that is in an environment where businesses can be profitable, stock markets can go up, people can get employed, even though you have 5 or 6% interest rates. And those retirees and pensioners that are looking for fixed income could actually get a fixed income. So it's not necessarily a bad thing if we have a strong nominal growth environment and we have higher rates. If you get higher rates because of purely inflation, that's a problem. But higher is not always bad.
Are you concerned about inflation maybe getting a little bit out of control if this administration pushes through with rate cuts, with tariffs and the like? Is that a concern?
Yeah, it's very much a concern that, we're not going to hit that 2% target, that inflation might be bottoming. I'll use that core CPI number again, somewhere around 3. It might start drifting higher, and the key word there is drift. Wow. It's not going to go massively higher. And that is going to then, put maybe put a little bit more pressure on the bond market. But nevertheless, I don't think it should be something that should be concerning to the point that we need to have drastic action in financial markets. I think what we need to do is understand that we're no longer in that period before 2019 when we were always below 2% on inflation. That cycle ended with COVID, and we're now in a post-COVID environment, and that post-COVID environment has a little bit higher inflation.
Jim, the Fed is focused on the labor market. How do you view the labor market?
The labor market has got two things going on with it. One, the data in the labor market is not too bad. The unemployment rate is still very low, 4.1%. The jobs growth numbers are still pretty good. Yes, I remember that we had 10,000 jobs because of weather and the hurricanes, and we'll see if that gets revised higher on the next number. But also keep in mind that there's been a massive change in the labor market. Work from home. Before, in 2019, before COVID, maybe 5% of the workforce was remote. And today, it's more like 30% of the workforce was remote. So we have a completely different workforce. We have a completely different way that we work, especially in service sector jobs. And that needs to be factored in. And if you're just viewing the world like you did pre-2019,
right,
you're kind of missing the point that the labor market has changed. And because it's changed, I think when you start looking at it, you start realizing it's not nearly as dire as a lot of Cassandros make it out to be.
Okay, so off Atlanta GDP now, are you saying there's a productivity adjustment that gets you out to, dare I say, 3.5% real GDP run rate?
There very well could be. I mean, Atlanta Fed is at 2.6. There's always been a problem with the productivity numbers that, remember, productivity is just take the total amount of money we spend on labor, divide it by GDP, and that's what you get for productivity. But the problem there is that, are we properly measuring GDP? Are we properly measuring technology and the technology improvements that we have? And that's why the productivity numbers have been a source of contention for decades now, whether or not we're measuring it properly. I think we're not measuring it properly, and we're probably a little bit more productive than we think we are. That should be a good thing for the inflation rate. It is. But I also think we're also in a post-COVID environment where we're in a higher run rate for inflation to begin with.
Jim, you're just absolutely brilliant and lonely 2 years ago saying inflation's not going to come down in a 2-ish level. In hindsight, Bianco rules. Jim Bianco with us this morning. Futures up 3.